What's up, traders, and welcome back. In today's video, we're going to be talking about financial ratios related to the valuation of a company. So there are a ton of different financial ratios, each of which is going to give us a different clue as to the current financial condition of a given publicly traded company. We categorize these financial ratios into four main categories, those being valuation, solvency, profitability, and growth. In this video, we're going to be talking specifically about financial ratios related to valuation. We'll be going over the enterprise value over EBITDA ratio, the enterprise value over free cash flow, the price to book, price to earnings, and price to free cash flow ratios. Now, each of these financial ratios is going to give us a different look at how expensive a company is. Having an understanding of how expensive a company is going to be a critical piece of the puzzle as far as identifying the most attractive investment opportunities. So without further ado, let's jump in and learn a little bit more about valuation. So valuation. Now this helps us answer the question, how expensive is a company? Valuation metrics look at figures associated with the relative price investors are currently willing to pay for shares of stock in a company. Now when I say the relative price that investors are willing to pay, I'm talking about relative to certain measures of performance. For example, the price to earnings ratio is among the more popular valuation ratios, and it looks at current share price divided by the most recent earnings that a company generated. This tells us how much investors are willing to pay for shares of a company for every dollar of earnings that company generates. It's important to remember that with any financial ratios, the average value of those ratios is going to vary from industry to industry, sector to sector. So the absolute value of any given financial ratio really doesn't tell you a whole lot in and of itself. It's when you put these numbers in the context of historical values and of industry, sector, and market averages that all of a sudden they're very meaningful and useful to us. For example, if a company is more expensive than it typically has been on average in the past, it wouldn't necessarily be an ideal time to enter a new position, as the expensiveness of that company might revert back to its average, implying a decline in the share price. Similarly, if a company is much more expensive than its peers, and we can't necessarily find a reason as to why it would be more expensive than its peers, it's probably not the most ideal time to enter a new position in that company. Now, the valuation or the expensiveness of a company is going to have several implications. For example, let's say we're evaluating the performance of a company and we see that right now, as far as several different valuation metrics are concerned, the company is much less expensive than it has been historically. Well, the next obvious question becomes, why is this company less expensive? Is it less expensive because the company is underperforming and it deserves to be less expensive? And if so, in what way is the company underperforming? When you use valuation metrics in conjunction with solvency, profitability, and growth metrics, we can gather answers to these questions and form really powerful narratives about the performance of these companies and the likely future direction of their share price. Now that we've laid a little groundwork as to what valuation metrics are, why they're important, and what they tell us about company performance and the relative attractiveness of these companies as investment opportunities, let's jump in and talk about the specific financial ratios that are going to help us gauge the valuation of a company. The first valuation ratio that we're going to talk about, and my personal favorite measure of valuation, is the EV over EBITDA ratio. Now, if you already watched our financial statements video from the fundamental analysis series here, you already have a pretty good idea about what EBITDA is. That's earnings before interest, taxes, depreciation, and amortization. It's a level of profitability derived from the income statement, and it tells us the profit that a company is generating after accounting for both the direct and indirect costs of producing the goods or services that generates the company's revenues. Long story short, it's a measure of profitability. EV, on the other hand, you might not be familiar with yet. That stands for enterprise value. It's calculated by taking the market cap, which is the total shares outstanding times the share price, right? So the total value of the equity of the company. Then it adds in the total debt from the company, and and it also adds in all the cash. So it's a pretty comprehensive measure of the total value of a company. So what then does EV over EBITDA tell us? Well, basically it's telling us what the total value of the company is for every dollar of EBITDA, for every dollar of profit when you account for the direct and indirect costs of generating the revenue. So how do we use EV over EBITDA and where do we find this information? Well, popping over to the Market Barometer here, I'm in the fundamental analysis section of the software and I'm on the valuation trend tab. Now this is going to give us access to all of our valuation ratios. And it's going to allow us to see how those ratios have trended through time and how they compare to industry, sector, and market averages. What's more is that we also see how those averages have trended through time. So the Market Barometer really gives us a ton of information about, a ton of different pieces of company performance. So we're going to come back to this after we've discussed the other financial ratios and see how to use the Market Barometer to really understand the valuation of a company. Next up is the enterprise value over free cash flow. So again, we're using enterprise value as a proxy for, the total value of the company. And this time we're going to divide it by free cash flow. Now, free cash flow is a measure of the cash left over after a company has paid all its expenses and capital expenditures. Free cash flow is a metric derived from the statement of cash flows. It takes the net cash from operations and subtracts from it the expense for capital expenditures. So it's a really stripped down measure of the efficiency with which a company is generating cash. And free cash flow basically refers to all of the cash that's left over to pay investors through things like dividends and share buybacks. So free cash flow itself is a really important measure of company performance. And when we set it relative to enterprise value, it's going to give us a good indication of the value of the company relative to its ability to generate cash. So it's similar to EV over EBITDA in a sense, only EV over free cash flow really focuses on the total value of a company relative to the cash flows that that company is generating. And I like this metric because, again, free cash flow, kind of like EBITDA, is pretty hard to manipulate. And when we couple this with EV over EBITDA, it gives us a pretty good perspective about the relative expensiveness of a company from several different angles. And this helps us to see through some of those accounting manipulations and variances that can occur because of generally accepted accounting principles. So in the interest of having even more perspectives and viewing valuation from even more angles, we have 3 more ratios to look at. Those being the price to book, price to earnings, and price to free cash flow ratios. Now, all of these, as opposed to setting some measure of performance relative to the enterprise value, the total value of a company, these metrics are going to be more price centric. So whereas EV over EBITDA and EV over free cash flow told us what's the total value of this company relative to EBITDA and free cash flow, these 3 ratios are going to tell us what is the price that investors are willing to pay related to these measures of value and company performance. So first up is the price to book ratio. Now this just takes the share price of a company and divides it by the book value of the assets that the company owns. Now again, this isn't an accounting course, so we're not going to dig too deep here, but essentially the book value of a company's assets refers to what that company paid for its assets less any accumulated depreciation. This is also known as the carrying value of the assets and refers to the current value of those assets as recorded on the balance sheet. So a price to book of 1 would essentially mean that the company is trading in line with the book value of its assets. Now, that would be a pretty good price because if you think about it, if the share price of a company is trading on par with the value of that company's assets, that means that all other things equal, the book value of the company's assets alone would be enough to justify the share price. But that's not even considering things like future cash flows and future earnings potential, maybe any other patents or other intangible assets that might have value. So a price to book to 1 would be extremely low. And anything below 1 would mean that the company is trading at a discount to the value of its assets and its assets alone. But generally, the higher the price to book number is, the more more expensive the company is relative to the book value of its assets. Next up, we have the price to earnings ratio. Now, this is arguably the most recognized, most popular, most often cited measure of valuation. It takes share price and divides it by earnings. Specifically in the Market Barometer software, we're looking at the trailing 12 months earnings. So it's taking the average of the earnings from all the income statements that have been reported over the last 12 months. Now, price to earnings demonstrates the price the market is willing to pay for every dollar of earnings that a company has generated. It's often referred to as the PE multiple, which basically just means, for every dollar of earnings, what multiple of that dollar of earnings are investors willing to pay per share? Now, earnings comes from the income statement. It's also known as net income. It's the bottom line of the income statement. So this is profit after accounting for all expenses and costs that were incurred by the company's regular ongoing business operations during that accounting period. Now, if you need a refresher on the income statement and earnings, go back to the financial statements video from the Fundamental Analysis Crash Course series here. Last up, we have the price to free cash flow ratio. Now, this just takes the share price and divides it by the free cash flow. So it basically tells us the price that investors are willing to pay per dollar of free cash flow. Now, we've already talked about free cash flow a little bit, but again, it just takes the operating cash flow from the statement of cash flows and subtracts the capital expenditures for that accounting period. This tells us how efficient the company is at generating cash, and the free cash flow is basically the amount of cash that's left over that can be returned to investors through things like dividends and share buybacks. So price to free cash flow specifically gives us an indication of the multiple of every dollar of free cash flow that investors are willing to pay per share. So now that we have a pretty good understanding of what each of these financial ratios is, how it's calculated, and more or less what it's telling us, let's pop into the Market Barometer and take a look at how to read and interpret these financial ratios and what they're telling us about the current state of the valuation of that company. So we're over here in the fundamental analysis section of the Market Barometer software, and I have us on the valuation trend page. Now, this is going to give us access to all the valuation related financial ratios that we've discussed so far in this video. So in the top left here, you get your ticker selection. Next to that's going to give you the company name, and then next to that, you get the sector and industry that that company is in. So right now we're looking at applied materials, which is in the technology sector, and the semiconductors industry. So the topmost chart in yellow here, that's going to be the individual company that you have selected. So right now we're looking at applied materials, and we've selected the EV over EBITDA ratio. The figure to the left of that, 13.73 here, that's going to be the average year-to-date reading of the EV over EBITDA for applied materials. So if I hover over the last data point here, 2020, you can see that that's 13.73, which is the reading we're getting over here. Below that in this light blue, that's going to be the industry median EV over EBITDA. So the semiconductors industry in this case, right? So it's going to take the median EV over EBITDA reading for all companies in the semiconductors industry. Below that in red is the same thing, but for all companies in the entire sector. And below that, same thing, but for all companies in the entire market. So this is allowing us to perform our comparative analysis by looking at the current readings at the company, industry, sector, and market levels, and then to compare how those things have trended through time. So a really powerful tool here that's going to allow us to build as much context as possible around the current reading in any of these financial ratios for these companies. One more thing to note is that these charts default to annual averages. So right now we're getting one single data point for every year, and that's giving you the average reading for that entire year. If you want to drill down and get a more granular look at that reading, all you have to do is hover over any of these charts and click this little down pointing fork here. That'll take you through what's called a date hierarchy. So it was annually aggregated data before. I've clicked it once, and now we're looking at quarterly aggregated. So we're going to get 4 data points per year. Click it again, we get monthly. Click it again, we'll get daily. If you want to learn more about the functionality and features of this portion of the website, check out some of the software specific tutorial videos over at marketbarometrix.com. All right, so I'm going to drill us back up through the date hierarchy here so we get back to annually aggregated data. So EV over EBITDA. If you guys need a reminder what this ratio tells you, just hover over the company name here and you can get the brief definition of each of these. So EV over EBITDA, again, is just the enterprise value divided by earnings before interest, taxes, depreciation, and amortization. It's going to indicate to us the total value of the company relative to EBITDA, which again is a level of profitability that factors in both the direct and indirect costs of producing the goods and services that generates a company's revenue. So currently, with an average 2020 reading of 13.73, Applied Materials is slightly less expensive on average than its industry peers, with an average year-to-date reading of 14.77. Now this, in my opinion, is probably the most important comparison that we can make. When we compare a company to its industry peers, we're looking at that company's performance relative to the performance of its direct competitors. So these companies should be very similar and should have very similar structures because they're in the same line of business. So Applied Materials, with an average 2020 EV over EBITDA of 13.73, is slightly less expensive, slightly undervalued relative to the median of its industry competitors. And when we compare the trend of Applied Materials EV over EBITDA over the last several years to that of its industry, we see that the expensiveness of Applied Materials has trended down, while the industry median EV over EBITDA has trended up. So that's a pretty important insight and something that we might want to look into further. Why has Applied Materials mostly become cheaper over the last several years, while the semiconductors industry in general has become more expensive relative to EV over EBITDA? Then we also see that more recently, between 2019 and 2020, Applied Materials has become quite a bit more expensive, while the industry median has mostly stayed the same. So these are important insights and are going to lead us to even more questions as far as, why has Applied Materials mostly become cheaper, but then more recently become quite a bit more expensive? So again, EV over EBITDA is going to tell us what's the value of this company relative to its profitability. Right now, it's saying that, relative to its industry peers, Applied Materials is slightly undervalued as far as the total value of the company relative to its profitability. I mostly use the sector and market medians and their trends as reference and, kind of a frame to contextualize the company and industry numbers. So as far as the total value of Applied Materials relative to its profitability, it's slightly undervalued relative to its industry. But, the semiconductors industry and Applied Materials itself is generally more expensive than the technology sector as a whole and the entire market as a whole. So that tells us that in general, companies in the semiconductors industry are going to have higher valuations than other companies in the market and other industries within the technology sector, which is an important thing to keep in mind because the higher the valuation, generally the more risk is going to be associated with those companies. Moving on to the price earnings ratio, I'm going to hover over the company name again here to get a quick reminder. Price earnings is the price divided by trailing 12 months earnings, compares the current price per share of a stock to its trailing 12 months earnings. And so this ratio again just tells us the price relative to the earnings it's generated. In this case, the trailing 12 months earnings. So again, we're getting more or less the same information here. With a current year-to-date average reading of 18.52, Applied Materials is slightly undervalued relative to its industry peers with an average year-to-date industry median of 21.55. And again, the semiconductors industry is generally more expensive than the technology sector as a whole, with a price earnings year-to-date median of 13.33 and also more expensive than the market as a whole with 11.29. So price earnings basically giving us one more angle, one more perspective as far as how expensive is this company. Only this time, instead of looking at total value relative to profitability, which is what EV over EBITDA told us, this is looking at the price specifically relative to earnings, which is a different level of profitability from the income statement. So this is essentially giving us even more confidence in the information we already derived from the EV over EBITDA reading. And we should more or less expect the rest of these valuation ratios to continue to confirm what we've already learned from the EV over EBITDA and price earnings ratios. And really what we're going to start looking for from here on down is, inconsistencies with what we've already found. And that's the whole reason why we look at all these different financial ratios, because even though they give us similar information and they're all indications of the current valuation of this company, they're providing us that information from different angles, right? Utilizing different pieces of the financial statements, which themselves give us different measures of company performance. So next we have enterprise value over free cash flow, EV over FC, FCF. Now this is going to be the total value relative to the free cash flow that the company is generating. So it gives us an indication as to the overall valuation relative to this company's efficiency at generating cash. So again, this is pretty much in line with what we've already learned from EV over EBITDA and price earnings. With Applied Materials slightly undervalued relative to its industry peers, but more expensive than its sector and market peers on average. Price over free cash flow, very similar to EV over free cash flow, but this time focusing specifically on price relative to free cash flow. And again, this is providing us with more or less the same indications. So now we're gaining even more confidence as to our interpretation of the valuation of Applied Materials. Next, we have price to book, which again is going to focus specifically on share price relative to the book value, the carrying value of this company's assets. And now this is a little bit different. We're seeing that Applied Materials price to book ratio is almost double the industry median and, is double the sector median and triple the market median. So for whatever reason, Applied Materials is quite a bit more expensive relative to the book value of its assets. Now, it's a pretty safe assumption to say that it probably has more to do with Applied Materials book value than it does with its price, because we've had price as a factor in many of the other financial ratios and haven't found any weird discrepancies like this yet. So I'm guessing, based on what I'm seeing here, that the book value of Applied Materials assets is probably quite a bit less than its industry peers. And that's making this ratio higher. And this is exactly the kind of thing that you find that, lends to the importance of looking at several different financial ratios. Because if you were judging the valuation of Applied Materials based solely on the price to book ratio, this wouldn't be a very good indication of how its valuation really stacks up to its industry sector and market peers. And it has everything to do with, in this case, the book value of the assets on Applied Materials' balance sheet. So another interesting question that comes to mind, with the price to book ratio so much more expensive than every other measure of valuation that we've looked at, is I wonder what their return on assets is, right? If they have less assets, are they doing a better job generating revenue and profit off of those assets than their industry competitors? All their other valuation ratios were more or less in line. Return on assets is a profitability ratio, and we're going to get into that in the profitability video as part of this crash course series. But for now, just know that those are the kind of questions that we're looking for, and when we perform our full fundamental analysis, we'll be able to start to answer those questions by looking at the various financial ratios. We'll be looking for discrepancies like this. Those will help us identify other important questions and really start to form a narrative about the company and Lastly, here we have the price to sales ratio, which we didn't cover in this video because it was just recently added to the software here. But this is just one more perspective on valuation. It takes the share price relative to sales or revenue, right? This is kind of a popular financial ratio for high growth type companies that might not necessarily be making a profit yet, but have a ton of future potential. So Applied Materials price to sales ratio is more or less in line with its industry peers and its sector peers. And, the technology and semiconductor industries, along with Applied Materials, trade quite a bit more expensive than the market as a whole as far as price to sales is concerned. So nothing really jumping out at us here, and more or less in line with most of the valuation ratios that we've looked at. So that gets us through our analysis of the valuation of Applied Materials. We've looked at the valuation for this company from several different perspectives. We've utilized several different pieces of the financial statements to get a really comprehensive look as to the current valuation of Applied Materials. We put that in context of its industry sector and market averages. Now, again, this is just one piece of the puzzle. Stick around for the rest of the videos in this crash course series where we're going to talk about ratios related to solvency, profitability, and growth. When we put all these different categories of financial ratios together, we can get a really comprehensive look at company performance, and it's going to help us identify those important questions that are going to help us to gain a deep understanding of this company, the factors that are driving its share price, and where the company's risks lie, and how attractive it is as an investment opportunity. There you go, folks. folks, a deep dive look into the financial ratios and processes involved in determining the valuation of a company. Now, this is a critical piece of the puzzle as far as evaluating the relative attractiveness of these companies for our investment opportunities. I know I just threw a ton of information at you guys, so feel free to go back and revisit any parts of this video that you need clarification on. And regardless of where you're watching this video, I'll do my best to get back to any comments or questions that you guys have, because I'd love to help you guys understand this stuff and utilize it in your day-to-day trading and investing. So if you guys like this video, don't forget to subscribe to the channel, hit that like button, comments and questions down below. Until next time, thanks for tuning in, and we'll see you guys in the next video.